All right, let's pay attention one more time.
Thanks, Mr. Chairman. Our first question is from a teacher in the Richmond district who is with us today in the boardroom. Would you please introduce yourself and ask your question?
I'm Robert Handy from Butler High School in Harford County, Maryland. What has been the greatest success as well as the greatest failure of the Federal Reserve in the last 100 years? And if you were teaching a high school U.S. history class today, what is the most important aspect of the Federal Reserve's role in history you would want students to understand?
Well, I hope that your students, if they come through civics or history, they learn about the Federal Reserve. It's a very, very important institution. It's had a huge impact in the almost about to our 100-year anniversary, about to celebrate our centennial. The Federal Reserve was founded in 1913. And it's been a tremendous, as I said, a tremendous part of U.S. economic history. I would say the greatest failure, to start there, is no doubt the Great Depression of the 1930s, to which the Federal Reserve made, unfortunately, an important contribution. The Fed was very slow to expand the money supply during the Great Depression. As a result, it countenanced a severe deflation or falling prices during the early 1930s. The Fed was also insufficiently proactive in trying to stabilize the financial system. As you probably know, about a third of all the banks in the United States failed during the 1930s, a tremendous collapse of our banking system. And those two things together were very important in making the Depression as steep and as long as it was. By the way, as we dealt with the financial crisis in 2008, 2009, we tried to take those lessons to heart. We tried to make sure that monetary policy was aggressive to prevent deflation, and we tried to take whatever steps were necessary to keep our banking system from collapsing. So at least we tried to learn from history. I think one of the most, or probably the most important success of the Federal Reserve in the past century was probably after the period of the 70s when we had a lot of inflation. The Federal Reserve under Chairman Paul Volcker brought down inflation, conquered inflation. We now have very, very low inflation, very stable prices. And in that process, in the 80s and the 90s, achieved quite a bit of prosperity and economic growth in the United States, and was a very, very important contribution to that period. Going forward, I think students should understand those two elements of what the Fed has done and hasn't done. And the first is financial stability. It's very important for the Fed to contribute to keeping our financial system stable and productive. And secondly, price stability. Only the central bank can affect inflation, and keeping inflation low and stable is good for our economy, and it's a very important responsibility for the Fed.
Thank you.
We talked about what they didn't do very well. We talked about four lines. We talked about what they did do well, which was what?
After the 70s, they brought down inflation. Paul Volcker.
Paul Volcker brought down inflation. So, since they deal with money supply and banks, what do you think they did with the money supply to bring inflation under control? Okay, pull the money in. So you're dealing with all of those various aspects to pull things together. And it's those aspects that then create what's called tight and loose, or what's also known as easy policy. Okay? Right? So, tight money supply, we pull that in. Okay? If tight money supply means you've got a really, 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 really tight pair of blue jeans on, what about loose?
You might have known I was going to say. You sweat it all out.
You're going to be holding your pants up with your hands. Sagging and bagging, huh? Okay, so this right here is that money is easily available. if it's really easy to obtain that money, where are you going to obtain that money from? Loans. So what does it tell us about interest rates? Way down, which tells us what about savings accounts?
Sucks for you.
Yeah, not a time to have a savings account.
Not the short one either.
Yep. Okay, so loans are easy. Interest rates are low. And you've got easy money floating around there. And loans are going to be easy to have. Who's that going to help? Consumers? Who else? Businesses. Okay, so you've got the consumer and the business. Consumers and businesses are going to be able to buy more, right? Whoops. Let's focus in on the company for a second. If the company is able to take out more loans, what do you think the company is going to do with that loan?
Expand.
New part of a business. So that means that they're going to be able to do what?
Hire more people.
Hire more people. So if you're dealing with a situation where we have high unemployment, which do you want, tight or loose?
Loose.
Okay, because with loose, it's going to encourage spending, which is going to ultimately bring in more workers, right? More jobs. So, loose and tight deal with opposite situations, right? What if you had high unemployment and high inflation?
Well, that could never happen.
Okay, I have to pick? Because is there a model here that tells us that we can deal with both?
Nope.
It's kind of an either-or situation. Right now, we don't have inflation. There's some inflation, little bits here and there, but not overall to where it's really impacting our purchasing power as consumers. But we have unemployment. We're down to 9%, which is good. We've been slowly falling.
Slowly.
Yeah. So which policy is the Federal Reserve using right now? Loose. Now, Ben Bernanke, when he was talking about Paul Volcker, he was talking about a time period in which we had both inflation and unemployment. And Paul Volcker was put into a position where he had to figure out, okay, if I do tight, I can pull inflation in. If I do loose, then inflation is going to continue to go up. And because inflation continues to go up, I may or may not be able to get unemployment under control.
Is this when you said that when Reagan started giving out a whole bunch of like tax benefits and stuff like that, and so he was doing the exact opposite of what he was trying to do?
Yeah, so you
He
had
was,
Paul
like,
Volcker, yeah.
He was trying to bring all the money back in, and you have Reagan giving back all these tax benefits, telling people to go spend their money and giving all this money back out to people.
Right, so you had Reagan with fiscal policy working on the unemployment side. You had Volcker on the monetary policy side working on the inflation.
Would you say that, like, I don't know if we are now, but we're at like a 10% unemployment?
We're down to 9.
And then, but like in Britain or whatever, they just accepted it as the new
The new normal.
normal. focus on inflation, then we can actually get our economy up and running, and then the 9%.
And I think that that's something that we learned with the Federal Reserve System under Paul Volcker. If we do focus more on inflation, deflation on the monetary side, then unemployment will take care of itself. And I think we experienced that clearly with Paul Volcker, which enabled us to move forward into the 90s, which becomes an incredible time of growth in our nation under Alan Greenspan. Now, there's some pros and cons with Alan Greenspan, decisions that he made with the loans, and that can be a whole nother area of debate where some of that responsibility goes from. All right, let me ask you this. What's the key difference between fiscal and monetary? Somebody give me one. Right.
Fiscal is kind of like what the government really controls, like as far as like the House of Representatives, like where the money's being spent. Monetary is like what the federal bank actually controls as far as money supply, how much is out there, and whether or not like the kind of loans that can be set out to the private banks.
Okay, so banks, government. Somebody else give me a difference between fiscal and monetary. Okay.
Fiscal policy generally deals with how they get the money, and like how they get the money for the most part, and then monetary policy is just how they control the value.
Okay, controlling the value and the usage of the money. Good. Skylar.
Fiscal spending the money, whereas monetary is more like manipulating it.
Good. Spending, how it's working, and the manipulation of it. Somebody else.
Fiscal is more heavily influenced by public opinion.
Good. Good. Has Ben Bernanke kind of been hit in the news recently?
Yeah.
I remember that QE2.
Quantitative easing.
Yeah, so he kind of got hit by a little bit of that. Okay, so public opinion did kind of affect, but does Ben Bernanke have to be worried about re-election?
No.
No. So that gives him a sense of freedom. Somebody else.
Fiscal controls the taxes and monetary controls interest rates.
Okay, good. Got taxes, interest rates. Anything else? All right. At this point in time, we are going to move on to getting ready for you to create your monetary and fiscal policy plans. Yes. In that, what you're going to be doing is you're going to take a look at this new country and what kind of shape this new country has been left in. You have to decide, okay, the government. Because I know that we didn't have these things then, but you guys get to play with it. If you were there, the founding fathers let you in the room, what would be the goals? What would be the things that you would suggest happen on the fiscal side? And monetary, what would be the things that you would suggest on the monetary side? Keep in mind what we left off at the end of the American Revolution was the fact that you had debt, you had inflation, you had tax issues that were all impacting the economic stability of the new nation, as well as 13 colonies that are now the new states that have all decided that they want their own currency. Okay? All right. Go ahead and brainstorm ideas with each other.